Hey guys, welcome back to another episode. Candlestick patterns are one of the most important factors when it comes to trading successfully, yet you'd be surprised that the majority of traders use candlestick patterns incorrectly. In this video, we're going to show you everything you need to know about trading candlestick patterns from beginning to end. So in order for us to keep producing these videos for free, we need your support by hitting the like button, subscribing, turning on the notifications bell. First, how to read candlesticks. You have your green candles, which are bullish. You have your red candles, which are bearish. This here is the candle body. These are the candle wicks. For green candles, the opening price is at the bottom here, and the closing price is at the top here. For red candles, the opening price is at the top here, and the closing price is at the bottom here. The wick ends at the top represent the highest price point. The wick ends at the bottom represent the lowest price point. So why are candlesticks important to understand? The candlestick pattern that forms acts as a leading indicator that tells you exactly what is occurring in terms of the buying, selling within the market at that particular moment in time, which then helps give you a directional bias to trade. And next, how do we use candlestick patterns? Many traders will take trade entries solely based on what candlestick pattern forms on its own, which results in low-quality trades. What we like to do is combine candlestick patterns with key levels and areas of confluence to increase the quality of the trade. And the higher the trade quality, the higher the percentage chance of success. Now, let's dive into the exact candlestick patterns we use. There are a multitude of candlestick patterns that traders use, but these are the ones we find the most effective and that occur the most often. Let's start with the first, which is the long wick candle. This is any candle where the wick is sticking out in the same direction as the moving trend. There are two variations that make it higher quality. First, the smaller the body of the candle, the better. Second, the longer the wick, the better. Also known as a very long wick candle. Let's now show how this is used in combination with key levels in an uptrend. Price came up, hit, and reversed, giving you your key level of resistance. As price came back up, you had a perfect long wick candle form right at the key level, presenting a trade opportunity short. So, what is the price action psychology behind this? Buyers tried to push price higher, but they failed to close it out. With momentum during that initial push, causing the wick to stick out, if they closed with momentum, the candle would have looked like a momentum candle. The long wick candle forms through a combination of buyers taking profit at the key level and sellers stepping in and opening new short positions. This double action causes prices to stall and react at that moment in time. Now, going in the opposite direction, price came down, hit, and reversed, giving you a key level of support. As price came back down, you had a perfect long wick candle form at the key level, presenting a trade opportunity long. The psychology. Sellers tried to push the price lower, but failed to close it out with momentum. The candle forms as sellers take profit and buyers step in, signaling potential reversal. Next, multiple long wick candles. This is when you have several long wick candles clustered together in an uptrend. Price came up, hit, and reversed, forming resistance. As price came back up, you had multiple long wick candles form at that key level, presenting a short opportunity. The psychology? Buyers tried over and over again to break the level for attempts but failed. Shows sellers held the level strong. In a downtrend, the reverse occurs. Sellers try to break support 3 times and fail. This shows buyers are strong and the support is valid. Next, the inverted long wick candle. This is like the long wick candle, but the wick sticks out in the opposite direction of the moving trend in an uptrend. Price came up and formed an inverted long wick candle at resistance, suggesting a short. The psychology. Strong sellers entered immediately, pushing price down and forming a wick below the body in a downtrend. It's the reverse. Strong buyers immediately pushed up when price hit support, forming a wick above the body. Next, the inside bar candle. This is where the high and low of the candle are inside the range of the previous candle. In an uptrend, price came to resistance. An inside bar formed, presenting a short opportunity. The psychology? Price failed to make a higher high showing. Loss of momentum from buyers. In a downtrend, price hit support. Inside the bar formed, price failed to make a lower low, showing sellers lost momentum. Hit like, subscribe, and turn on the bell. Now, on to consecutive shrinking candles. This is where every candle gets smaller and smaller. In an uptrend, candles shrink as price approaches resistance. This shows loss of buyer momentum. If it ends with a reversal candle, for example, long wick, the setup quality increases in a downtrend. Shrinking candles before support show sellers are losing steam, especially if followed by long wicks. Next, candles increasing in size. In an uptrend, if a long wick forms at resistance and candles increase in size afterward, that shows heavy selling has entered the market. This gives trend change confirmation. You can short in a downtrend. Increasing candles after support show buyers stepping in strongly, signaling a long opportunity. Next, candle color change. This is when a series of one-color candles ends. With an opposite color candle in an uptrend, many green candles are followed by a red at resistance. This shows loss of buyer control. In a downtrend, red candles followed by green near support show seller exhaustion. Next, momentum candles. Large-bodied candles that dwarf the ones before them. In an uptrend, a long wick candle may form. But a more secure entry comes after a large red momentum candle forms, confirming heavy seller entry in a downtrend. After a long wick candle at support, a momentum green candle confirms buyers stepping in. One question we get is, how do you use these in bullish, bearish, and sideways markets? Trend trade in an uptrend clear, higher highs lows. At the confluence area support plus MA plus 61.8 fib, you get long wick candles, but don't enter yet. Wait for trend change confirmation like a follow-through momentum candle. Then take the long, same logic in a downtrend. Look for a long wick at resistance. Wait for trendline break and momentum confirmation, then short next. Reversal trade in an uptrend resistance level. Shrinking candles, long wicks show price tried and failed multiple times. Line break in bearish momentum confirms reversal. Short it in a downtrend reversal at support with long wick candles. Trendline break and higher high equals long entry. Reversal continuation trades work the same. You get a double top or bottom, then a pullback. Long wick candles react to new resistance, support. Trendline break confirms continuation in the new direction. Now, let's apply multi-time frames. In an uptrend, long wick forms on 6 hour at a confluence. Jump to 30-minute. You see a double bottom, trendline break, higher high long entry, earlier than on a higher time frame. Why? Early entries mean more profitless exposure to trend exhaustions. Same for downtrend on 8 hour, pullback to confluence. On 2 hour, double top or lower high. Then trendline break and bearish momentum, earlier short. Reversal and uptrend on 6 hour, inside bar at resistance. In 30-minute, draw a trend line, wait for a break, then short and downtrend on 4 hour. Long wick candles. On 1 hour, you might see divergence, RSI or double bottom, higher high, confirming long. Now, false candles and reversals. Price reaches key level. Long wick forms, you go long, then price breaks through, you lose. Why? No trend change confirmation. You got trapped in a fake out. Always confirm reversal before entry. Use a lower time frame to see if price actually breaks trendline and forms. Higher high in downtrend or lower low in uptrend. Real example, Twitter stock momentum candles. Trendline break. If you went long just because of wick, you got trapped. Same for Bitcoin. On monthly, multiple long wicks near ATH. Whales likely took profit. Later, a second reaction gave confirmation to close positions. On a weekly trendline break gave further confirmation of reversal. As traders, your job isn't just to find good entries. It's to protect profit and manage exits wisely. So what about imperfect trades? If two key levels are close together, don't draw both. Draw a zone. Treat it as a general area to look for candlestick reactions. Then confirm reversal through price action plus trendline break. On lower time frames, you might see triangle channel, wedge patterns. Breakouts give the signal. One more tip, don't stress over exact entry precision. Trade style is personal. Some want only clean levels. Others are okay with zones. Final tip, sometimes a false breakout happens. Price pierces above resistance. You think trade is invalid, but you wait for trendline break. Then short, remember trade zones as areas confirm with trendline break and price action use. Multi-time frames to time your entry earlier to trade. Just wicks combined with patterns. Thanks for watching. Hit the like button, subscribe, and turn on the notification bell. We'll see you in the next episode.